Welcome to House Lux Estate, your reliable source for all things real estate and economics. Today, we delve into a topic that's been making waves in the economic world: the economics of Bitcoin. Bitcoin, this seemingly abstract digital currency, has positioned itself as a viable and influential player in the global financial landscape. Its decentralized nature, coupled with its finite supply, has sparked curiosity and debate among economists and enthusiasts alike. How does it factor into our existing economic systems? What's its potential impact on our future financial structures? These are the questions we'll be exploring. We're not just talking about a digital currency here, we're talking about a revolution that's challenging the very fundamentals of economics. As we dive into this labyrinth of Bitcoin economics, we hope to shed some light on its complexities and the intrigue that surrounds it. Stay tuned as we unravel the complex world of Bitcoin economics. To understand the economics of Bitcoin, we must first look at its inception. Our journey begins in the year 2009, a time of financial uncertainty, when the dust from the global financial crisis was just beginning to settle. Here, in the depths of the internet, Bitcoin was born. The brainchild of an anonymous entity known as Satoshi Nakamoto, Bitcoin was not just a new form of money, but a radical experiment in economics. This digital currency was unlike anything the world had seen. It was decentralized, meaning it wasn't controlled by any government or financial institution. It was created through a process called mining, where powerful computers solve complex mathematical problems to verify transactions and add them to the public ledger, known as the blockchain. But what was Bitcoin's initial value? When it first appeared, Bitcoin was worth virtually nothing. The first documented purchase with Bitcoin was for 2 pizzas, which cost 10,000 Bitcoins. Imagine that, 10,000 Bitcoins for 2 pizzas. So if Bitcoin started from nothing, why was it created? The intention was to create a currency free from governmental control, a currency that could be sent instantly, anywhere in the world with no fees. It was designed to be scarce like gold, with only 21 million Bitcoins ever to be mined, to retain its value over time. But it was also designed to be democratic. Anyone with a computer could mine Bitcoins and participate in the economy. And because every transaction was recorded on the blockchain, it was transparent and resistant to fraud. Did it succeed? Well, from an initial value of virtually nothing, Bitcoin has grown in worth to tens of thousands of dollars per coin. From being an obscure internet curiosity, it has become a serious player in global economics. Bitcoin began as an idea, an alternative to traditional currencies, and it has grown into a financial powerhouse. But our journey doesn't end here. Stay tuned as we delve deeper into the economics of Bitcoin. Like any commodity, Bitcoin's value is heavily influenced by the principles of supply and demand. Now, you may be wondering, what exactly does supply and demand mean? Well, in a nutshell, it's a basic economic theory that explains the relationship between the availability of a particular product and the desire of consumers for that product. In the context of Bitcoin, supply refers to the total number of Bitcoins that are currently in circulation, plus those that are yet to be mined. Demand, on the other hand, is determined by the number of people who want to own Bitcoin, either as a means of payment or as an investment. Now let's delve a bit deeper into the supply side. Bitcoin's supply is unique in that it's finite. You see, when Bitcoin was created, it was coded to have a maximum supply of 21 million coins. This means that unlike traditional currencies, which central banks can print more of, there will only ever be 21 million Bitcoins. This limited supply introduces the concept of scarcity. Scarcity in economic terms refers to the basic economic problem of having seemingly unlimited human wants in a world with limited resources. Because Bitcoin supply is capped, it is scarce, and this scarcity has a profound impact on its price. On the demand side, various factors can influence people's desire to own Bitcoin. These can range from its potential as a hedge against inflation, its use as a means of payment, or even its potential for high returns as an investment. When demand for Bitcoin increases while its supply remains the same or decreases, its price tends to go up. This interplay of supply and demand creates a fascinating dynamic, where the finite supply of Bitcoin meets the potentially infinite demand of the global market. This is one of the reasons why we see such volatility in Bitcoin's price. So, in essence, the limited supply of Bitcoin coupled with increasing demand, driven by its diverse uses and its potential as an investment, creates a potent mix that can drive its price upwards. As with all things valuable, the scarcity of Bitcoin drives its price upwards. Bitcoin's volatility has made it an attractive, albeit risky, investment. Investing in Bitcoin, or any cryptocurrency for that matter, is not for the faint-hearted. It's a high-stakes game, with the potential for incredible highs and devastating lows. This is primarily due to the volatility of Bitcoin. One day, it's soaring to unprecedented heights, and the next, it's plummeting to unforeseen depths. This volatility is driven by various factors, including regulatory news, market sentiment, and technological advancements, among others. Yet, it's this very volatility that makes Bitcoin an intriguing investment. It's akin to a high-risk, high-reward venture, where the potential for significant gains is balanced against the possibility of substantial losses. And let's not forget the thrill of the ride. Investing in Bitcoin is not a passive activity. It demands vigilance, attention, and a stomach for uncertainty. It's also important to remember that Bitcoin is a relatively new asset class. It's still in its infancy, and as such, it's subject to the growing pains and uncertainties that come with any emerging market. This includes questions about regulatory oversight, market stability, and long-term viability. These uncertainties add to the riskiness of Bitcoin as an investment. However, despite these risks, Bitcoin has shown an impressive track record. Since its inception, Bitcoin's price has skyrocketed, outperforming traditional assets like stocks and gold. This has led some investors to view Bitcoin not just as a speculative asset, but also as a potential hedge against traditional financial systems. But let's be clear, Bitcoin is not a get-rich-quick scheme. It requires a thoughtful and strategic approach. It's essential to do thorough research, understand the market dynamics, and be prepared for the possibility of losing your investment. Some investors may be drawn to the allure of quick profits, but it's crucial to remember that with high reward comes high risk. It's a gamble, and like any gamble, it should be approached with caution and a clear understanding of the potential consequences. Investing in Bitcoin can be a roller coaster ride, but for some, the thrill and potential payoff are worth it. Bitcoin isn't just a digital coin, it's a global economic phenomenon. As we delve into the realm of Bitcoin's impact on the global economy, we find that its influence is more significant than one might initially perceive. It's not just about a novel form of currency, it's about the transformative power of a decentralized, borderless financial system. The first ripple effect of Bitcoin's existence has been the birth and growth of other cryptocurrencies. Bitcoin's success has paved the way for thousands of alternative digital currencies, collectively known as altcoins. They range from Ethereum with its smart contract functionality to Litecoin, often dubbed as silver, to Bitcoin's gold. The proliferation of these cryptocurrencies has in turn spurred innovation and competition in the digital marketplace. But the influence of Bitcoin extends beyond just cryptocurrencies. It has sparked global interest in blockchain technology, the underlying mechanism that makes Bitcoin and other cryptocurrencies possible. This technology, with its ability to create secure, transparent, and tamper-proof records, has potential applications far beyond digital currencies. Industries from healthcare to supply chain management are exploring ways to integrate blockchain into their operations, promising increased efficiency and security. Financial institutions have also been profoundly affected by Bitcoin's emergence. Initially skeptical, many have now begun exploring ways to incorporate Bitcoin and other digital currencies into their operations. This shift has been driven by a recognition that digital currencies offer numerous advantages, such as faster transaction times, lower costs, and increased financial inclusion. Moreover, Bitcoin has challenged traditional notions of currency and value, forcing economists and policymakers to rethink their understanding of money. It has raised questions about the nature of currency, the role of central banks, and the future of the global financial system. In essence, Bitcoin has become a catalyst for change, pushing us towards a future where digital, decentralized currencies could play a significant role. Its influence has permeated various sectors, sparking innovation and debate. Bitcoin has evolved beyond a digital currency. It's now a significant player in the global economic stage. So there you have it, the economics of Bitcoin in a nutshell. We've journeyed from the birth of Bitcoin, delving into its innovative design, which has revolutionized the way we view currency and transactions. We've explored the principles of supply and demand and how they shape Bitcoin's value. We've also shed light on Bitcoin as an investment, highlighting the potential rewards and risks. Moreover, we've discussed the significant impact of Bitcoin on the global economy, from its role in diversifying investment portfolios to its influence on monetary policy and financial markets. Bitcoin, with its decentralized nature and potential for high returns, has certainly disrupted traditional economic models and continues to shape the future of finance. Remember, understanding Bitcoin economics is not just about comprehending how this digital currency functions, but also about recognizing its broader implications on our economic landscape. Thank you for watching. If you enjoyed this video and want to learn more about real estate and economics, don't forget to subscribe to House Lux Estate.